literally everything you can ask for this week. Earnings, economic data, the Federal Reserve. Let's take it step by step and get some charts to accompany all of the major themes with Mr. Ben Breitholtz joining us once again, the data scientist from Arbor Data Science. Ben, welcome back to the show. You got a lot of charts this morning.
Always. Yeah, we try to keep it fresh and fun and colorful.
All right. Yes, very colorful. Let's start with the consumer chart that you've got, which tries to gauge basically what people are doing. And this one's particularly interesting. Walk us through the methodology here, because we've got a bunch of different colors on this chart that show what people are searching for: furniture, restaurants, food, etc.
What we're trying to do is quantify the intentions of consumers. So what are they doing and what are they going to do? And during the pandemic, you can see in this chart, there's search activity on a rolling 3-month basis, adjusted for seasonality and noise, that just rocketed higher. And that had everything to do with things like food delivery, furniture, personal computers, setting up their home offices. And on the flip side, restaurants, movie theaters, job interviews, all of those got demolished, meaning they weren't searching for those type of topics. But over the past maybe 2 or 3 months, we've seen nothing but everything essentially on the rise. That's both goods and services, which bodes very well going forward and is confirmatory of the retail sales we saw for March, right around 10%. New home sales still chugging along at 20%. So on a month-over-month basis. So really the consumer's looking strong here going forward.
Okay, so the blue theme generally is more about going out, as we see the blue taking over. A lot of that coming from people talking about even movie theaters, restaurants, flights are in there as well. And we have to go back to, far beyond anything in this chart, given that we're at highs for a lot of those particular search terms. How long have you been looking at this data, Ben? Do we have any idea what this looks like, compared to like a pre-COVID level?
Yeah, these are some of the best levels we've really seen. And this goes also to, if you look just at the actual economic data, not a surprise, the change in traditional economic data relative to their 1-year average growth rates it's some of the best that we've seen really on record. And again, I think that bodes well that the consumer will keep spending, yes, maybe helped by the fiscal stimulus front, but they're getting out in droves and spending in both services and goods and looking to make a jump back out into the real community. Another space too that is actually looking on the up and up is the rental market, and this is something that had been in really the doldrums since the pandemic, and we're starting to see the same type of search activity show up for 1-bedroom apartments, vacation rentals, VRBOs, and so on, which also could be a precursor to OER, owner's equivalent rent, one of the big sticking points for inflation, finally getting unanchored and finally rising from that kind of low 2% year-over-year level.
Interesting. Okay, so possibly some rent prices starting to move in tandem with some of these other themes. So, Ben, what's interesting, though, within all of this is you've got a chart on here that measures folks are searching in a bearish or bullish manner, and I don't think I've seen this one from your team before. So, again, walk us through the methodology. Super interesting, though. This is people searching for things related to bear or bull markets. What exactly is it?
Yeah, with the frenzy that was, starting during the pandemic of Robinhoods and then ultimately the GameStop and so on, we wanted to get a handle on these small investors. So we're looking within small investment kind of categories on Google and looking for bullish and bearish search topics. And bullish would be things like call option, longs, leaps, and so on, whereas bearish should be things like put options, short, market correction, maybe some economic terms like bankruptcy, and so on. And what we found was really wild is that the spread between those search trends put on a Z-score basis was rather predictive of the direction of the stock market. And so, as you can see, we've highlighted in blue and red the S&P 500 periods where we get bearish search topics dominating or being more fervent than bullish. We end up seeing congestion and or nasty drawdowns in the stock market. We hadn't seen one of these, that we had been nothing but good times since April or May of last year. All of a sudden, which is kind of bizarre, over the past maybe 2 weeks, we've seen the bearish search topics finally rise above the bullish search topics. And one thing I've been trying to wrestle with is this more of, buy the rumor, sell the fact? Now that we're finally seeing, search activity and the consumer get back out in the open, they're wanting to potentially get new rents, new housing. And we also are potentially seeing the workplace come back in vogue, in that people are starting to make their ways back into offices. If you look at some of the Castle indices measuring on a metro by metro basis, those have been ticking up nicely in the past few weeks. And we also see job postings rising at almost a 40 to 50% clip relative to pre-pandemic levels, new job listings, meaning that people, businesses want to get people back out and back into the workforce and back into offices. So I'm more and more questioning whether or not this is, again, the buy the rumor, sell the fact. Now that this is kind of coming to fruition, are investors believing this is kind of priced in?
So, Ben, just to be clear, this is not a spread of the rate of change between the two, where if something was if it was a very, very bullish signal and now it's just less bullish, that's not showing up as bearish, right? These are just kind of one extreme versus the other.
Yes, correct.
Okay.
And we do this on obviously on many different fronts. But again, if you look back historically, it's pretty surprising how predictive the small investor has been in terms of their actual attitudes of the markets. And typically they're kind of looked at as, I don't like to use these terms, but kind of the dumb money. But in this case, they really haven't been. Right.
This past couple of years in particular, as we see that big surge in the bullish language down near the bottom relative to bearish. But similar to your data goes all the way back to 2008, 2009, where that spread worked very well in timing the bottom too. It seems like timing the tops, we generally see that spread turn a little bit more bearish, but then it follows through and it has some pretty good timing ability off the lows as well. So very interesting metric here as we see some bearishness creeping into the language and the thought process of some of these investors. Super interesting chart. Let's go over to some more of the macro themes that you're looking at. When we look at the rates market as being potential for volatility in equities, if maybe that's one of the things these bears are thinking about, well, it's calmed down a lot lately, Ben. What does history tell us might come next in terms of the recovery path for yields after an event like we went through? Even though somewhat unprecedented, I know you've tracked basically kind of historically what the chart looks like after a recession.
Right. So yeah, when we look at global recoveries, typically we'll see 10-year yields rise about 100 basis points. And what we did is we look at OECD composite leading indicators. And when we get better than 50% of economies around the globe, looking at 38 individual economies, that is our marker that we're into this, a strong kind of bullish recovery after being in somewhat of a recession. So the chart here is showing you the average path of 10-year yields on the top, the 6 months prior to that signal, meaning, again, OECD says, we're in this bullish scenario. And you can see that 10-year yields have actually tracked this somewhat well. And this trend typically continues over the next at least 3 to 5, maybe 6 months. Yes, maybe not at the same clip, but usually the trend is higher and higher. Yes, we've seen this move we've seen already in 10-year yields has eclipsed what we typically see on average to the peak. But at the same time, that momentum usually continues for the most part. So really, the recipe is there for higher yields. And how I've been looking at this lately is that the initial inertia drive higher yields we saw beginning in February had everything to do with real yields, had everything to do with the Federal Reserve and potential for taper talk and for rate hikes. And yeah, that's still continuing. And now we have economists saying that tapering could begin in December or January of 2022. But what you see is a transition unfolding right now between who's driving yields, real yields or inflation expectations, meaning tips break-evens. And if you look at the simple correlation of those two to nominal yields, a nominal 10-year yield, all of a sudden inflation expectations, tips break-evens, are seeing their correlation rise from, they were at 0, they weren't really connected at all, and that's all of a sudden escalating over the past month, while real yields still remain, of course, a dominant theme and highly correlated. But we could be in a transition right now from overt Fed focus to inflation, given the incredible rise in intermediate goods, and now we're getting some actual indications from companies like PG&E, Whirlpool, Snap-on that they will indeed be raising prices on consumers. So I think that story is going to become more and more front and center for investors.
So lately, even though we've gotten yields slowed down amid some of the good data, it might make us wonder, okay, has this type of stuff been priced in? According to your chart, well, we were already so far ahead of pace compared to other recoveries. Then also just the length, as you point out on another chart, record-breaking duration of a drawdown and the price of bonds. The other one for the dollar there too, Ben, there's a lot of people counting on a lower dollar, but the chart doesn't necessarily look like that has to happen according to history.
No, and the dollar is going to be a special circumstance, and I think for me it has everything to do with the differentials in shadow rates. So shadow rates between central banks are essentially their target rates, accounting for QE or their actual purchases. And the U.S. shadow rate, Fed funds target rate, shadow rate, is somewhere around negative 150 basis points or so. And that will creep higher once we start to get this tapering to unfold. And our expectations are that shadow rate should come back to somewhere around 0 basis points. And relative to more dovish locations like the ECB, that means we're going to get a pretty big differential in those very, very short end rates, which is somewhat supportive of the U.S. dollar. So we continue to eye, for example, DXY, somewhere around 90 as a base, as a low point. But getting back to yields, I think, again, this is kind of a technical situation for the most part. It's hard to envision a scenario where yields are going to precipitously drop unless all of a sudden the consumer gets alligator arms over their spending. And yes, we have all of these different indicators showing complete oversold scenarios. You have Sharpe ratios on a 6-month basis across the entire curve around negative 2.5. That just doesn't happen very often. Okay. Another thing you brought up is the monthly breakouts. If you look at just a simple rolling 1-month breakout for 10-year yields, we had the longest bear trend on record at 166 days and it ended April 15th. Yes, yields typically fall from there, but a lot of the fundamentals remain strong and for the economy, and it looks like the inflation scenario is starting to finally heat up. Whether or not investors truly price that in, we'll have to see.
All right, great stuff. Definitely a nice juicy setup for us this week with all the data. Awesome work as always. Always surprising and fun to see what you guys are cooking up there, Ben. Appreciate it.
Thank you.
Thank you, Ben Breitholtz, data scientist at Arbor Data Science.